First and foremost, Adam, what we're seeing is a complete restructuring of the real estate capital markets. So you have the growth in retail capital, whether because of forthcoming defined contribution reform,
Hmm.
whether because of the shift from defined benefit plans to individual retirement managed by people, is growing exponentially. And in turn, the capital markets in real estate are increasingly reliant on the retail channel.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this YouTube podcast series, Real Estate Market Watch, current events through a real estate lens. All right, so my guest today is Tim Bodner. Tim is a partner at PwC's real estate practice and leads PwC's global real estate deals business. He also coordinates the firm's US real estate strategy, culture, and talent development across his company's network. And he advises some of the world's largest real estate investors, from private capital firms and REITs to sovereign wealth funds and corporate owners. And he has worked on over $300 billion of IPOs, debt offerings, mergers, and acquisitions. Well, it turns out that as of tomorrow, of course, this podcast is going to go out slightly late. I'm just trying to get it published as soon as possible. But tomorrow, November the 5th, they are releasing their PwC is releasing I think it's a partnership with Urban Land Institute, with ULI, their 2026 Emerging Trends in Real Estate report. It's absolutely fascinating. If they will let me, I will put a link to it on the show notes page. So go to gowercrowd.com, try and find the podcast, just hit the podcast button. And there should be a link there on the show notes page to the report. And the idea was that we were going to talk in some detail about the report. But what we ended up talking about was kind of the bigger picture around the findings that you will discover in that report, and the ambiguities, if you like, that exist between the findings of the report and the anecdotal insights that Tim has gleaned from his conversations with individuals in the industry, all of whom typically are running very, very big real estate companies themselves. Okay. While you're at gowercrowd.com, if you've not already done so, go ahead and subscribe to my newsletter. Comes out as often as these podcasts do. I try and put one out once a week, and you can always unsubscribe. I talk about capital formation, best practices, and some AI stuff once in a while, some thoughts about the economy, and of course, summaries of these conversations that I'm having in this podcast series. Okay, let's move on. Tim Bodner, partner at PwC and Global Real Estate Deals Leader, coming right up. Tim, what a pleasure to see you. Thanks so much for joining me on the podcast today. All right, so I'll tell you what, let's start at a high level, and then we're going to get into some remarkable stuff, and I'll prompt you on that as soon as we do. But why don't you just tell me first, what is your role at PwC? What do you do? Like, what does the daily grind look like to you?
Yeah, well, no day is the same, Adam, and particularly right now, it's quite fascinating what's happening. So first, thanks for having us and for thinking about the firm. We appreciate it. So listen, first and foremost, I'm a partner at PwC. Been here for most of my career. I sit within our deals business, which is our mergers and acquisitions business, focused on strategy, mergers, acquisitions, divestitures, capital raising, and other event-driven events. I've looked after the business here in the U.S. for the last almost 12 years, and looked after our global business
Mm.
uh, for the last 3 years. Our clients are family offices, high net worth investors, sovereign wealth funds,
Mm.
REITs, real estate service providers, private equity firms, and corporates. And we operate, across the entire value chain and across the world.
Um, Japan?
We do.
You're in Japan as well. That's right.
And you know what's actually remarkable, back to your theme, is
Yeah.
it's actually one of the most active parts of the world right now.
It's Japan.
Yeah.
Okay, so we should definitely talk about that. It's not the
Happy
topic
to.
of this, but right, like after we sign off for it, because I'm going to ask you, I speak fluent Japanese. I actually ran
Okay.
the real estate division of Universal Studios. It's a JV,
Okay.
Universal Paramount, in the 90s. So I still have this, and my PhD is on Japan. It's all kinds of things. So let me ask you about that afterwards. But it's off topic for today.
Sure.
Before we started talking, well, before we started recording, I'm going to quote you exactly. I'm dying to hear what you meant. You said, "It is remarkable what's going on." Okay.
Yeah.
What are you seeing out there that strikes you as being remarkable?
So, first and foremost, Adam, what we're seeing is a complete restructuring of the real estate capital markets. So you have the growth in retail capital, whether because of forthcoming defined contribution reform,
Mhm.
whether because of the shift from defined benefit plans to individual retirement managed by people, is growing exponentially. And in turn, the capital markets in real estate are increasingly reliant on the retail channel. One chairman of a very large private capital firm told me last week that by 2030, they expect that 85% of their AUM comes from the retail channel. That
Wow.
is a
85,
eight-
85.
85%. Now, when you think about that number, the reaction often is how you reacted. Now, the other thing we need to talk about is we need to talk about what's happening in the insurance market. And so as this shift happens from defined benefit to individuals, as the burden shifts from employer to employee, the other thing that's happening in the background is the entire retirement system around the world is built in a way to fit the accumulation phase of one's retirement strategy. The decumulation phase is not where a lot of products are focused. That's a problem in and of itself, but what compounds it is that people are living longer. Just on average, the people are living longer. And so you need uh, those retirement savings to last for a longer period of time.
Mm.
What that's causing is it's causing a significant uptick in the annuity sales across the world. Those annuity sales can be viewed as a source of retail capital, and that's filtering into the real estate ecosystem. So number one, the growth of retail capital relative to institutional is a profound shift that's happening in real estate. The second thing we should talk about is what's happening in the finance markets. As you know, for the longest period of time, the vast majority of finance and real estate was driven through the regional banking system in the United States. Some metrics would say it's 85%.
Mhm.
Those lenders are not nearly as active as they have been. And so what's happening is that's also causing a significant growth in private credit. And in particular, uh, through the insurance channel as well, because of the favorable cost of capital that the insurance company capital provides relative to the alternatives. So the equity and the debt side is changing significantly. In addition to that, what is real estate today? When most people talk about real estate today, they talk about multifamily, office, retail, etc., right?
Mhm.
What we see is a real estate investable asset class that's increasingly converging with infrastructure. We like to call it real estate and real assets. Sports, live entertainment, senior housing, student housing, affordable housing, manufacturing facilities. These are all investable asset classes that we see traditional sources of real estate capital increasingly focused on. We can talk about marinas,
Mm.
golf courses. The the real estate asset class was the largest asset class in the world before this. But if you look at it through this expanded definition of real estate and real assets, that is a remarkable thing to think about, just how big that really is. The third thing I would say is that um, real estate and real assets are being increasingly looked to as a source of value creation in an environment where the cost of capital is, for the foreseeable future, structurally higher. Sure, we're in a rate cutting cycle in the US. We're in a rate cutting cycle in Europe. That's true. But the long-term rates are still somewhat elevated. Doesn't mean they're high, they're just elevated relative to where they have been. And so what that means is that there needs to be a new levers of value creation that are looked upon. And real estate and real assets are increasingly part of the picture. Why do I mention that, Adam? Because we increasingly see market participants outside of traditional real estate market participants looking at their tangible assets and saying, how can we use them to generate material value for our core business? Or how can we use them to generate cash to reinvest in our core business? We can talk about battery storage. We can talk about power and utilities. We can talk about healthcare, pharmaceutical and life sciences. We can talk about consumer markets businesses. All these things, we just take a step back and we say, it's pretty remarkable to think about everything and this is all happening. This is all happening simultaneously. And so we are very optimistic about what we see now. It doesn't mean there's not challenges. We can talk about office if you'd like. We can talk about retail if you like. We can talk about the issues, in supply. We can talk about the issues in affordable housing. We can talk about all that. But when you just take a big step back, it's a pretty unique time in history from a real estate and real asset perspective, and that's why we say it's remarkable.
Okay, so let's drill down on some of those topics specifically.
Sure.
There's one that has definitely caused a little bit of confusion in the small part of the real estate industry that I inhabit, and that is this idea that trillions in new liquidity will pour into private real estate through retirement plans, 401ks, etc. Can you explain exactly what the EO, or at least the new regulations, are permitting? What will that look like actually for institutions, for sponsors, and for individual investors? How will they see that? How will it manifest?
Well, listen, the defined contribution market globally is trillions and trillions and trillions of dollars. And when you look at the percentage that those plans are invested in private markets generally, it's something like 2% or something like that, right? If you look at it relative to institutions which are closer to like 11, 12, some 11, 12%, that's a significant delta. And so if you're a private capital manager today and you're thinking about how do I think about my AUM growth long term, having just a fraction of access to that retail market is material. And so that's why it's such a hot topic among private capital managers. And we've seen some of that already start to happen. But what hasn't happened, and when I say it's already started to happen, is some private capital managers have created real estate investment trusts that are focused on the retail channel. But that hasn't gotten after the defined contribution. The defined contribution system's not invested in those products. If they were, it would be exponentially larger. Why hasn't it happened? The main reason it hasn't happened is because of the legal risk associated with opening up products to those plans. And so a lot of plan sponsors have been reluctant to do it. You mentioned the executive order that the current administration signed, 90 to 120 days ago that addressed that. What's happened since then is that the SEC has also put their weight behind this. And so we are optimistic that over time that market will open up broadly to private markets, and real estate will be one beneficiary of that. But it's not just real estate, to be clear, Adam. It's private equity, it's private credit, it's infrastructure. And the other reason why it's so important is if you look at what the S&P 500 today and what's driving that return, it's really 7 or 8 businesses that are driving the vast majority of the return. And so if you think about it, and some private capital managers have been on record saying this, if those businesses trade down or there's some kind of disruptive event, that would be a significant issue for our retirement system. And so there is a pragmatic view that by enabling those plans to invest in private markets, avoid some of that volatility and be more diversified, that's a positive, not just for the managers, but also for the plan participants.
So that's an interesting period in time. I have written about this recently. They say that the way to be successful in any kind of trading is to buy low, sell high, right? But how do you do that? Right? It's kind of a glib statement. But it strikes me that right now is the perfect time to actually sell high and buy low, sell the stock market and buy real estate. Stock markets are clearly at a historic highs, and real estate is bumping on, commercial real estate is bumping along bottom. So you can actually do that. But let me just understand. I just want to unwrap this, and this might be difficult to answer only because of the lens through which you see the world. So I'm going to try and explain it through how a lot of people in my world see it. So they now think that, okay, great. It's a deregulation, private now. You can use your 401k to invest in private real estate, but does that mean, and I know what the answer is, but I want you to articulate it. But does that mean now that everybody that has a 401k can say, okay, I'm going to invest with, Joe Bloggs down the road who's doing a development at the corner of Walk and Crosswalk. I'm going to invest in his syndication using my 401k. That's not what's happening. So just explain exactly. When I said, what are people going to see? How is it going to manifest? How are they going to see private equity real estate and be able to invest in it through their retirement accounts? What will that look like to them?
Yeah. Well, what needs to happen is it needs to be the particular investment options need to be adopted by the sponsor. And just like today, you have a menu of choices that you can invest in. This would be another choice.
But what will it be? It'll be like one of the major funds will say, okay, now we're offering private equity real estate as one of your options to invest in, and here are the risks and reward profiles, whatever. And then they will take the money that you invest and they will invest it with individual sponsors. Again, we're very careful who we're talking about. Use the word sponsor.
I think we need to be. So when I use the word sponsor, Adam, I'm referring to a traditional sponsor of a 401k plan.
Right. That's your sponsor.
That's my sponsor.
Okay. So when I talk about an operator, somebody who buys, apartment buildings in their region, adds value, and then sells them in 3 to 5 years. All right. They kind of churn that kind of. Those are let's call them the operators. And those are the people that I help find retail investors.
Yeah.
So they think, in some cases, great, 401ks are open. Now, all of our retail investors, right, all these hundreds of people that are investing in our deals, they can now use their 401ks to invest in our deals. That's not what's going to happen.
No, but I think what you're getting at, Adam, is another really important point, which is, and I was actually having this conversation yesterday with a mid-market operator, to use kind of the terminology you're using. And we were having the question around we were sitting having a conversation, and he said to me, what role does retail capital need to play in my strategy moving forward? And
Hmm.
I said, well, what role do you think it should play? And I think that's the question that people need to ask themselves is in a world where institutional investors are a smaller part of the overall pie. Not saying they're declining, but they're just a smaller portion because of the growth in the retail channel.
Hmm. Hmm.
If you don't have a retail strategy, then what does that mean? And so it may not be, from my perspective, that your retail strategy involves getting access to the 401k defined contribution market. But
Hmm.
there's other avenues through which you can get access to the retail channel, whether it's various exempt regulations that the SEC has around a number of
Right.
like that you can pursue to get after that channel, whether it's family offices, high net worth investors, so on and so forth. Our view would be if you don't have a retail strategy today,
Mm.
you should have that's something that I think you should stare hard in the mirror about and ask why is that the case and what will be the replacement for, what's going to be the source of capital moving forward if you don't have that.
Well, that's a good question, isn't it? So so your suggestion, by the way, I love that you're saying that because that's all I do is bring retail investors to operators. And we've got to be careful. Use it
Yeah.
to a professional, a real estate professional who's got a shop. I would call them an operator. That's all I do is help them do that. So from what you've said, then what you are seeing is that even for those folk, the institutional pipelines will move further away from real estate. Is that the idea or not? Because I heard something slightly contradictory. You also said annuities. So as people grow older, there's more money going into those. So, but that's institutional capital.
I
That
don't view it that way though. I
oh,
view
you
the
don't?
no, and I because at the end of the day,
Hmm.
the other side of that annuity is a person. The
Right.
institution is an intermediary.
Yes.
They have the capital. Ultimately, they have an obligation to fund. Need to invest in. They need to invest that. The private markets make a lot of sense. But at the end of the day, if you go back to the stat I mentioned of the manager who said 85% of their AUM is going to be from they include annuities in that.
Really? Okay. See, because I've always thought that actually. I've always thought it's interesting when you talk about going to retail or going to institutions. All right, retail to me means calling individuals essentially and saying, would you, right, Joe Smith, like to invest in my syndication? I'm doing a, multifamily over here. That's the individual, the retail investor. And I've always thought of the institution as being basically the same thing because that same retail investor has an insurance policy, has an annuity, has a 401k. It's the same, it's their money that's just coming through a different channel, essentially.
Yeah,
To
so let me put a finer point on it because I understand where you're going with that.
Mm.
I it is different in the sense that if you think about a traditional institutional investor like a pension plan or a state retirement system,
Hmm.
in that case, the capital is not tied back to an individual policy like an annuity is.
Hmm.
So we should talk about what's happening in the institutional marketplace too. So if I look at the U.S. state pension plans as an example, what's happening with the U.S. state retirement system is actually also going through a transformation where the U.S. state retirement system is saying, we used to always invest indirect. We used to say, we'll give you X million to invest in your fund.
Hmm.
What's happening now is they're saying, we'll give you something for your fund, but we also want to go direct and we want more co-invest opportunities. So the US state pension funds are going more direct as well. The sovereign wealth funds outside of the United States, in places like Asia, the Middle East, and like, are doing similar things, but different in the sense of, in some cases, they're saying, we'll invest capital in your business, but in turn for doing that, we want you to invest in our country. Same thing's happening with foreign pensions too. So the reason I mention that is it's not just the retail channel that's going through a transformation. It's also the traditional institutional segment that's going through a transformation as well, where they're wanting to go more direct versus indirect.
When you say more direct, direct to what exactly?
Meaning we'll invest in an operator, like, to use the terminology. We'll invest in the operator, or we'll invest in the operator plus we'll give you we'll commit X million to co-invest
Really?
alongside you. And the reason why that's happening is because if you think about where we are with a higher cost of capital, their hurdle rates have gone up.
Mm.
And in some way or shape or form, they need to address that. Now, that's not an easy thing to do, right? Number one, a lot of these traditional institutional investors, their operating models are not set up to invest directly,
Mm-hmm.
and they don't have the capital to build the infrastructure to do that. So what do? You think about things like managed services, big business for us as a firm, big business for us, managed services, to work alongside people who can't build the infrastructure, or it may not make sense to build the infrastructure. The other part of it is, when you think about what they're doing is, how do they move with the speed that some of these traditional institutional investors require, or managers require, operators require. There's one large private capital firm that said to me, every conversation we've had in our latest fundraising cycle has involved a conversation around, we'll give you X million for your fund, but we want X co-invest opportunities. And their response was, great, we're happy to do it. But here's what we need from you. We need you to move at the same speed that we move, because what we can't have happen is we can't have the co-invest opportunity slow down the deal speed. So that's a constraint, if you will, on the ability of these managers to move into more of a direct investment.
That's interesting you say that, Tim, actually. So what is that constraint, though? If you have an institute, let me just understand exactly what you're saying. So again, I might be asking dumb questions.
Oh, no.
Forgive me if I do. But so what I understand, so we have operators, who are the people who are running the deal, right? They've got multifamily, but they have the team, they're running it, right? They're the operator. And then you have institutions, and typically you would have, or in some cases, have private equity shops that sit in the middle, and they raise money from the institution. They may raise $1 billion fund. That's a multifamily fund, and then they take that money and they invest individually with the operators. Right, they'll find the operators and they'll invest individually with them. So there's a couple of layers of promote, right? You've got the private equity shop, you've got the operator, the private equity shop, two layers of promote, and the institution that's making the investment. What you're saying is that the institution, it's a question, is that the institution is saying to that private equity shop, okay, we'll invest in your fund, but we also want to go through, we want GP economics. We want your carried interest economics as well at the operator level. So almost cherry picking. We like this operator even more, so we want to put more money into their shop. Is that did I get that basically right?
It's a great summary. And in
Okay.
fact, Adam, I would tell you that, working with some of the largest sovereign wealth funds in the world, they've been doing what you just described for years, in some cases. Some cases. And they're doing exactly what you're just saying, is they're investing directly in the operator and kind of taking out that middle layer that you're describing.
Okay, so why is that? Why does that create any kind of friction for the operator in terms of timing? Because presumably, well, hang on. So our intermediary, the private equity shop, they're doing all the due diligence. So the due diligence from the institution has been done in the private equity shop, and so there's no friction for the operator. The issue is that when the institution leapfrogs frogs to the operator, they now need to do a whole other layer of due diligence, and that's what slows things down.
Well, and that's also where the pressure on the operating model comes into play, Adam, because if you
Mm.
think about it, and you have been you know the industry, they're not set up to, in many cases, to do a lot of those due diligence
Well, they're
activities.
too small as well in most cases, right? These things.
And so what do you do? So that's where you start getting into conversations around what's the operating model of these large institutional investors for the future?
Mm.
What do they choose to build in-house? What do they choose to outsource? How do they think about things like managed services? We haven't even talked about technology and AI and all these other things yet. What role do those things play? And these
Mm.
are all questions that we are actively dealing with on a day-to-day basis, which is
Mm.
what is the right answer? And the honest answer is
Mm.
there probably isn't a completely right answer.
Mm.
But what there is there's an optimal answer for each particular circumstance. And that's the art in figuring out what that is for each particular, because all these, to your point, some of them are small, some of them are very large. There's
Mm.
some, if you look at the US state pension system as an example, there's some state pension funds that operate today like large private capital firms,
Mm.
infrastructure, people, resources, budget, technology, so forth. There's others who are not even close to that. And so that's the balance.
Okay, last question on this topic, and then I want to move to asset classes because that's
Sure.
all interesting thing you talked about. But what's causing this? I mean, it sounds seismic, actually. These shifts you talked about it as being the word used was remarkable. What's going on? What's why now?
Yeah, it's a great question. So I would say a couple things. Number one is um, the operating environment today, just in the terms of the cost of capital, is the highest it's been in the last 25 or 30 years,
Hmm.
right? That's number one. Number two is the impact of technology. And I'm not talking about AI. I'm just talking about, let's just talk about technology in general. It is a expensive proposition to fund the level of technology investments that are needed to operate in this new environment. To operate in that new environment, you need scale, you need access to resources. And that is in part, if you go back to what we were talking about in terms of kind of the consolidation among managers, that's a big driver of that. So those are two examples. The last thing I'll just say is that when you look at it, and we just did a publication that we call our Value in Motion series, where we talk about how the entire world is moving into these ecosystems, how we fund, how we feed, how we care, so on and so forth. These ecosystem shifts are profound and they're happening all over the world. And so those are like three reasons why this is all happening now. But it doesn't mean it started now. It's been happening slowly for a while. It's just been accelerated. You could also argue that the pandemic had a lot to do with it too.
Hmm. You don't think that there's a case to be made for the current administration's approach to liquidity, deregulation, interest rates, etc., is also serving as a catalyst for profound change in the industry?
So look, when you look at the current administration's policy, certainly in certain places, their deregulatory mindset, particularly around antitrust, is a positive factor. Let's look at the banking system, the banking
Hmm.
industry as an example. The level of M&A activity in the banking system is as significant as it's been in a long period of time. You you know, so there's certainly that deregulatory mindset, their stance toward antitrust is impacting certain places. But no, Adam, I wouldn't say that what we're seeing is solely because of the current administration's
Mm.
policy, and we wouldn't frame it that way.
Yes, I meant catalyzed
Yeah,
by,
yeah,
stimulated by, rather than solely as a result of. But certainly the other thing, so we've mentioned another report.
yeah, yeah,
Will have made Logan very happy that you did that. But in the emerging trends in real estate report, actually,
yes,
I've been privileged to have a pre-look at that.
yeah,
It's okay to even admit that I did that. Comes out tomorrow anyway. And so
yep,
by the time this podcast is broadcast, it will be available, and I'll put a link to it on the show notes page. But you've also talked about a fog, this idea that there is the capital market, or that real estate leaders generally consider the environment as being in a fog. And yet you're talking about considerable change and some major shifts. So what exactly what did you find in your research
yeah,
that's described that suggests that the market is in a fog? What does that mean exactly, and how
yeah.
are operators acting?
Yeah, well, thank you for bringing it up. So, yeah, you're referring to our emerging trends in real estate report. We've been doing it for more than 30 years. We issue a US, an America's edition. We issue a European edition, which also got released this week. We have a forthcoming version on Asia, and then we have a global overlay.
Mm,
We're in a privileged position where we talk to thousands of people all over the world to inform our insights on this. We also do, in conjunction with the Urban Land Institute, a number of surveys. And as a result of doing all that research, we get access to privileged perspectives around what people think is happening in the ecosystem. And so if you link your point around the fog to what we've been talking about, a
mhm,
lot of what we were just talking about creates uncertainty. What
mm,
adds to that uncertainty is what's happening in the geopolitical environment. What adds to that uncertainty is what's happening from a public policy environment. That creates this fog that's in the system.
mm,
Now, what I would say to you, Adam, is that the density of that fog is becoming less dense,
lifting. Mm,
and it's lifting, and
mm,
people are getting more clarity around what's happening in the world. So,
mm,
for example, we got clarity on tax reform. We got the One Big Beautiful Bill Act.
mhm,
We have more clarity on trade. Is it perfect? No. Are there uncertainties? For sure. But there's more clarity than than there had been. And so
mm.
that is reducing the uncertainty. So when we are getting at the fog that's out there, that's what we're referring to.
And how are operators then changing in terms of their interaction with the market? Are you seeing transactions going on, optimism growing, or as the fog clears, are people increasingly pessimistic? And
Yeah.
not, but
I'm an optimistic person by nature, Adam. So I always tend to find the silver lining in just about everything. But what I would tell you
mm,
is that if we had this conversation 8 to 12 months ago, I would have said that the way folks are navigating the fog is they're moving into alternative asset classes, things
mm,
that where there's more clarity around what's happening. What I would say now is we've seen a sharp rotation back into the traditional asset classes. So, for example, we've not seen the level of activity in the office market,
mm,
in a long period of time. But in the last 60 to 90 days, we've seen three companies been taken private in the office sector, and the level of optimism around
mm,
the office sector is as high as we've seen it in a long time,
mm.
even in places like San Francisco.
San Francisco is extraordinary, actually. I've been tracking San Francisco. But San Francisco always does this. It collapses to kind of total obliteration. I remember this during the GFC as well. And those that had the courage and the staying power to buy in when everybody else was fleeing absolutely killed it, to coin a phrase. I mean, and you can see it happening again. It just copy paste. It's totally predictable, isn't it?
Why is that though? Right. And so if you go back, and I'm active on LinkedIn, and you can
Mm,
see every year I go to San Francisco, and for the last 2 years I've done something on this, and you can go back 2 years and I've said the same thing.
mm,
Why is it that people haven't seen places like San Francisco for what it really is?
mm,
Which is that it is a um, unique, uniquely situated city in the world.
mm.
Just like I remember, and you probably remember this too, during the pandemic, everyone's like, New York's gonna go away.
Yeah,
I'm
that's
doing this podcast sitting in New York right now.
right.
And I'll tell you, the level of activity around New York, even with the overhang of the current, municipal elections, is palpable.
Yeah.
The city is back, and during the pandemic, everyone was saying everyone's leaving New York to go to other places. Well, you can't move what's sitting here in New York. So I think it's another place to say it's remarkable what's happening, and I've always been a big fan of San Francisco. I think New York I put in that bucket. I think many people would. And in fact, to draw a direct linkage to our emerging trends in real estate report,
Mm.
if you look at the top 10 geographies, cities to invest in, four are in New York.
Four cities. Well, hang
There's
on.
four,
Yeah.
four, four kind of boroughs, areas around New York: Jersey
Right.
City, Brooklyn, Manhattan, and one other. And
Mm.
that is a remarkable. So I can't remember the last time that's happened.
Well, this is why now is a good time to buy. I sound like such a classic real estate broker, don't I? I mean, they always say that. But I really do think that. I mean, having been through now two major downs, like really major downturns, savings and loan in the 90s and then the GFC, the pandemic was definitely different. Had the characteristics are definitely very different. But they're always the same. There's a cataclysmic collapse that leaves everybody incredibly pessimistic, and then it pulls out again. And those that go in with a bit of courage and some cash, and have the stamina to be able to hold on for just long enough, they always come out extremely well. I mean, it is consistent pattern throughout history. But you mentioned something else as well, and this emerging trends report. Also, you've been talking about this today, has identified some other asset classes. And when I talk about asset classes, I mean inside of the real estate world. And you've talked about data four, actually, not replacing the four major food groups, but definitely nudging them to one side, at least temporarily. So that's my question. Is it temporary? Data centers, senior housing and MOB, medical office buildings, and self-storage. Do you want to talk about those? I see senior housing and medical office actually as kind of being grouped together, the aging of America. But do you want to talk about the way that you're seeing this center of gravity move into these different asset classes?
Well, listen, the discussion around what's happening with data centers is well covered and understood. The level of CapEx investment going in
Oh,
uh,
to AI? Yeah, right. Yeah.
building new infrastructure
Yeah.
by the hyperscalers and others
Mm,
is not slowing down. It's accelerating, and real estate market participants are capitalizing on it. Now, what I would say about that, Adam, is that there are headwinds to that theme. The
mhm,
availability of power is one. The regulatory environment is two. In fact, there's one state election going on today, actually, as we're talking, that one of the significant policy issues is in and around the level of data center construction happening in that particular state. Why is it so significant? Why is it being so significant there? It's because of the regulatory environment that has fostered people moving into that. What's happened as a result of that is it's caused a significant acceleration in the cost of electricity on consumers. It's put
Mhm.
pressure on the grid. So data centers, because of the growth in AI, because of the growth in cloud computing, because of mobile devices and the amount of data that's being produced, it has incredible tailwinds behind it. Having said that, there are constraints that need to be carefully monitored. So it is by far the number one uh, uh, asset class for investment purposes covered in our report. It's also the number one for development purposes, and there's a lot to be optimistic about. But we do think you need to be clear-eyed about it.
So for mortals, sorry, just to talk about data centers a bit more. The people who are investing in data centers are, again, huge institutions, huge organizations that have the depth but for mortals that like me who live in this sub-institutional level, where are the opportunities
Yeah.
around data centers and this boom in AI?
Yeah. Well, I think if you go back to our conversation around the private markets, one way that a retail investor could participate is, of
Mm,
course, there's public companies that are the two scaled public companies that are terrific businesses that have been around for a long time. That's one way to play the data center theme from a retail perspective. That's not at the same scale that the institutions. That's one way to do it. The
mm,
second way to do it is when you think about what's happening in our conversation around the private markets and the proliferation of retail capital and access to funds and other vehicles sponsored by these firms. That's another way to play it. Your point, though, is a great one, and that's something that even today,
mm,
I was with one of the another very large institutional investor, and we spent a considerable amount of time in this environment. How do you play in this? How do you
mm,
play this theme?
mhm,
One other way you can do it is around things like covered land plays. So
mm,
invest in the land that could be utilized for data center construction because it's got access to power and other things.
mm,
So there's a number of ways you can do it, but your point overall around just the level of capital that's required is a real one. And it's not just, to be clear, from our perspective, it's not just something that is a consideration for retail investors. It's a consideration just generally, is how we look at it. Senior housing,
yes.
uh, when you look at senior housing is a fascinating topic for a couple different reasons. Number one, everyone's been talking about the gray tsunami for a long
Yes.
period of time. The aging of the baby boomers, the first set are reaching the age of 80 this year. It's a narrative that's been out there for a while. The demand driver has always been clear. The question is, how do you do it in the right way? The reason I say how do you do it in the right way is that the senior housing business is an operationally intensive business.
It is.
And so,
Yeah.
how do you think about the acuity of care?
Mm,
Is it independent living? Is it assisted living? Is
mhm,
it CCRCs? How do you think about things like skilled nursing?
mhm,
So it's a sector that has incredible demand tailwinds behind it. Supply is virtually non-existent. There's been no new supply, but
mm,
there's risks depending upon where you are in the continuum. The other thing that I'll offer, Adam, on the senior housing space that I think is important to talk about, and that is what's happening with consumer preferences. We've seen examples where traditional multifamily businesses in some of the best places in the United States and around the world have had incredible multifamily product, great occupancy, and some of their tenants have gotten to the age of kind of 60, 65, 70, 75, and they're in great physical condition. But they're saying they don't know what's going to happen tomorrow. None of
mhm,
us. So how do they think about replicating their experience in an environment where they have access to things that they could need but don't need today? Some call it active senior communities. There's other terminology for it, but it's almost like if you're in a multifamily community today, uh, apartment community today and you're concerned about what's going to happen in the future, how do you create an ecosystem where you can move from a traditional multifamily environment apartment community into one that kind of is not assisted living, independent living, but is somewhere kind of in between where it offers various amenities and like. And I will tell you that I don't think anyone's really figured that out yet, but it's important because the other thing that we're seeing is that um, people don't want an S. The motivation for moving into a traditional senior community is, there needs to be something significant that pushes them there, and so there's a reluctance to do that. And long term, when you look at the growth in the seniors, the great tsunami, that's an important challenge that needs to be resolved.
Yeah, it's interesting. So is there a large, I always thought of the baby boomers as being the last generation of homeowners, actually, rather than apartment dwellers. That's where their wealth is. That's the wealth that's going to be passed to their heirs. Um, so I never really thought of them coming from apartments, the impact being on apartments, more selling their homes and using that to pay assisted living fees.
Well, listen, your point, and the last stat that I have seen around what you're getting at, which is the level of home equity
Hmm.
that seniors have, is in the trillions of dollars.
Right.
And that money is certainly significant enough to fund a move into what we're talking about, whether it's independent living, assisted living, and so on and so forth. But there's a reluctance to do that. And so I actually look at what you're talking about as a constraint on demand
Oh.
versus a tailwind demand, which is that's capital that's tied up that needs to get unlocked. The other thing that we should talk about is let's talk about housing affordability. Who's the buyer to
Hmm.
unlock that value for this cohort to move into some of these things? Right now, I mean, I live in Washington, D.C., I'm in New York as we speak. Affordability of housing is a huge issue. And a lot of people are saying, like, listen, we would love that house that family's owned for generations, but we can't anywhere near pay what they're offering in this market. So it's a complex equation, and I view that as a constraint versus a tailwind.
That's interesting. All right, so we should wrap up on that point, but I'm going to disagree with you slightly there.
Okay.
That actually, I do think is, it's something that evolves over time. But the thesis is that the baby boomers will gradually, pass away, right? Pass on their wealth to their heirs. And as soon as those heirs inherit, they will be the buyers of somebody else's home, somebody else's baby boomer, some other baby boomer's home, because they will have inherited money from one home to invest in another. So I do think that it will be recycled. But it's going to take decades. It's not something that's going to happen quickly. All right, Tim, let's wrap up. Let me ask you, with one last question. So what signal? Probably not. I'm like Columbo. I always have just one more question, so what are the main signals that you watch, Tim, that help you assess how the industry is evolving, what direction we're going? What are the key indicators that you track?
So the first thing I pay attention to, Adam, is I've always viewed real estate to be at the center of every industry. At the end of the day, there's a real asset or a piece of real estate uh, that's involved. And so, what's happening with the consumer, what's happening in healthcare, what's happening in technology, media, and entertainment, all
Mhm.
those other industries that use real estate those are all demand drivers and supply considerations. And so that's the number one thing that I spend a significant amount of time focusing on because usually what's happening in some of those other places drives something that's happening in real estate. It's just
Interesting. So it's
it's
like a general macroeconomic outlook.
just general. So we think about it. We have five industry groups that we think about here at PwC. We think about financial services, we think about consumer markets, we think about industrial products, we think about healthcare, we think about technology, media, and entertainment. If you look at those five, what's happening in those five is really important to what's happening in real estate. So that's one thing that I spend a ton of time focusing on. Um, Number two is what's happening geopolitically around the world and what the impact of those geopolitical factors are on capital flows is really important in terms of kind of inbound and outbound capital is important to me. Those are probably the two biggest things. What I don't spend a lot of time getting hung up on is what's happening around kind of the things like interest rates, because at the end of the day, I think when you look at what's happening with interest rates, great, we're in an easing cycle around short-term rates, but that doesn't necessarily always correlate to what's happening in the rate that matters, which is in general the 10-year. So it doesn't mean that it's things that I personally and we ignore, but these other things are things we pay more attention to because oftentimes what we've seen is that there's opportunity that's found in those areas, and you can go back to your point around the fog. Oftentimes, that's where the fog is not present, and that's where capital moves. So that's where, to answer your question, that's where I tend to spend most of my time focusing.
Tim Bodner, am I pronouncing your name correctly?
Got it.
Tim Bodner, partner PwC and Global Real Estate Deals Leader. Thank you so very much for joining me on the podcast today.
Great for seeing you, and thanks for having us.
All right, that was Tim Bodner, who is partner at PwC and Global Real Estate Deals Leader. Tim, enormous pleasure to meet you. Thank you so much for spending your time with me, and also thank you for the little after chat that we had. I did enjoy that. I look forward to following up with you. And thank you, dear viewers and listeners also. I'm sure you found it of tremendous interest to hear some of the things that Tim is talking about or talked about during the podcast. And just to reiterate, all being well, on the show notes page, I will be able to include a link to the 2026 Emerging Trends in Real Estate report. I'm looking at it on my screen now. It does say under embargo, so I can't share it today, but I will be able to share it tomorrow. It's a partnership between PwC and Urban Land Institute. And yeah, it's extremely detailed and extremely fascinating. So, and also include a link to Tim's LinkedIn profile and also, of course, the PwC there on the show notes page. So do go there to gowercrowd.com to learn more about the report and also about Tim and PwC. And if we're not connected, one last thing before I go today, if we're not connected on LinkedIn, go ahead and connect with me. You'll find me, just look me up, Adam Gower or Gower Crowd, should pop up fairly quickly. Hit the follow button. I think it's the follow button. If you want to connect, just click, and you'll be able to connect instead of follow. And yeah, and then let's engage in some conversations there on LinkedIn. It's a great place to exchange ideas and meet interesting people. All right. All right, that is all I've got for this week's podcast. Thank you so much for joining me. Tim, thank you again very much. It was a real pleasure. And so for this week, until next time, this is Adam Gower signing off.